Welcome to Basic Business Skills Training. We are now going to look at Module 2. Module 2 is on determining financial requirements of a new business venture. In this module, we will discuss financial aspects as well as financial matters of a new business as well as of an existing business. For this module, we will look at the following topics. We will look at how you determine the financial and cash flow requirements for a new business venture. We'll look at determining the income and expenditure of a new venture. We're looking at how you can implement costing and pricing principles for your business. We'll look at how you can manage cash flow for your business. And we'll also look at how you go about preparing a budget for your business. And lastly, we'll look at how you can identify resources to obtain startup capital for your business. Please note that Module 2 is divided into two sections, two parts. There's a Part 1 and there's a Part 2. Part 1 is the current video that you are viewing now. Part 1, we're going to look at the following topics. We're going to look at determining the financial as well as the cash flow requirements of a new business venture. We'll then look at determining income and expenditure of a new venture. Then we'll look at costing and pricing principles for a business venture. When you reach the end of this video, you will reach the end of Part 1. You'll be directed to Part 2, which will contain the rest of the topics of this module. So money is an important aspect of any business. To survive or your business to be successful, to run your business, you need money. Money is the lifeblood of a small business. It's therefore important that you manage your money. Make sure that you have enough money, making sure that you have the right amount of money. It's essential that you manage money flowing in and out of your business. Within a business, we've got various types of costs that we need to be aware of as small businesses. There are 4 types of costs that we have within an organization. First of all, we have what we call our startup costs. We have running costs, we have cost of capital, and we have staff costs. Startup costs are going to be costs or expenses that you incur when you are creating a new business. Remember that when you're creating a new business, there are various activities that you need to carry out, and those activities you need to pay for. All businesses are different and will have different startup costs, but there are costs that are going to be common to all types of business. Example of startup costs includes costs like research, insurance, licensing and permits. Remember, to operate certain businesses, you need to have a license or permit, and in the process of acquiring a license or permit, you may incur certain costs. Within a business, you need to have equipment to run a business, so you also need to purchase equipment. So you may incur costs relating to equipment. When you begin a new business, you need to promote and advertise that business. So in the process of creating your promotional material, creating your adverts, you are also going to incur costs. So you must know what are your startup costs. You must also know what is going to be the total cost of your startup costs so that you have sufficient money to begin or to start your new business venture. We also have what we call our running costs within a business. Running costs are also called operating costs. These are going to be costs or they're going to be money that you are going to pay on a regular basis when you are running your business. So you will incur these costs on a monthly basis. These types of costs are going to include costs such as salaries and wages that you pay to your employees, electricity, rent, telephone rates, utilities, costs that you incur as a result of running your business. We also have what we call is cost of capital. Cost of capital is the opportunity cost of making a specific investment. It's the rate of return that could have been earned by putting the same money into a different investment or into a different venture, but that venture would have a similar risk or the same risk to the one you actually invested in. So cost of capital is the rate of return required to actually persuade an investor to make an investment. Staff costs are going to be costs that are associated with your employees. Remember that as an employer, there are certain contributions that you might make to your employees' medical aid and their pension fund. So those costs as well are costs that you pay as an employee. So you need to know what are going to be the staff costs within your business. So for your new business venture, you must know what are your startup costs, what's going to be your running costs, what's going to be your cost of capital, and also what is going to be the relevant staff costs so that you are able to budget appropriately and make sure that you have got sufficient money to actually start as well as run your business. Within your business, you need to make sure that you keep appropriate records in terms of finance. So you need to record all aspects that relate to finance. So you need to record all financial matters. You need to record money in from all sources. Money that comes into the business is known as your income. And you also need to record money that goes out of the business, which is your expenses. Income is money received. Examples of income can be money that you generate from sales from your customers when they buy from your business, money you've saved or borrowed from the bank, so money that you invest into the business could also be money in. When you obtain a loan from the bank that you're going to utilize or use for the business, that's also considered as money coming into the business. Expenses, this is money spent. This is money that you are going to use. It's money that you're going to use to buy stock. It's money that you use to pay for transport when you are going to buy your stock. It's any other expenses. It's money that you can use to pay for rent. It's money that you use to pay salaries and wages. So why do we need to record income as well as expenses? We need to record income and expenses because of the following. To be able to calculate the money you've made, you need to keep accurate records so that you can see if you are indeed generating what we call is a profit, if your income is greater than your expenses. So to calculate money that you've made in the business, you need to make sure that you are recording. We record to also see if the business is succeeding. If the business is succeeding, it means that it's able to pay for its expenses, and it also means that its income is greater than its expenses. So we record to see if the business is succeeding in terms of either it's making a profit or it's making a loss. And then lastly, we record so that we are able to calculate whether the business is making a profit or a loss. So as a business owner, it's important that you record all monies that come into the business and all monies that come out of the business. This will enable you to see how much money is being made in the business. It will also assist you in terms of seeing whether the business is succeeding or failing, and also to see whether the business is making a profit or a loss. So it's important that you record your income and your expenses. So how would you record your income, which is your money received, and your expenses, which is your money going out of the business? You can create a table similar to this one, where you will have your money received and you would record on a monthly basis. So you would have under money received, you would record money received from cash sales. You would record money that you received for payments on account. you'd record money that you may have received from new loans or money that you may have received from any investment. So on a month-by-month basis, you'd have to record money that you received as a business, which would be your income. You'd then have a total of what is your income. You then need to record what are your expenses. This is money spent or money that goes out of the business. So you would list the various type of expenses and you would capture the amount for each expense. Remember to calculate our profit or loss or our cash flow. We also need to calculate what is the difference between income, which is money received, and our expenses, so that we're able to track if the business is making a profit or a loss. So to record, you can make a table similar to this one where you would record your money received as well as your money spent, so that you're able to track and see whether your business is making a profit or a loss. You can also create a table similar to this one where you can record your income and expenditure. So on your left column, you could record your expenditure. So record all expenditures that you incurred during the month. And on the right-hand column is where you are going to be recording your income. And then you would also do a comparison between the two to see the difference, to see if your income is greater than your expenditure, to actually calculate your profit, or if your expenditure is greater than your income, to see if you're making a loss. So you need to decide which of these two templates would be more appropriate for you to use. But it's important that you have a record of your income and your expenditure. Now that we know the importance of recording money going in and money going out of a business, you can do this short little exercise where you can record on a daily basis what sort of money comes into the business and what money goes out of the business. You would record the date, you'd describe what the money that came in was for, and you'd also give the amount, and then you'd also look at money that came out of the business. This also allows you to also be able to track the various coming in and out of money in your business on a day-to-day basis. So you can use this activity to just look at money out and money in on any given day within your business. So within a business, you need to be able to calculate your profit as well as the loss that you're making within your business. So there are various formulas that you need to be aware of, and you also need to be aware of the various profits that you need to calculate within your business. So profit is money that's earned by the business after paying all the costs of producing or selling a product or a service. So profit is when you are looking at all the money that you've earned, less the expenses that you incurred, or less the cost that you incurred to actually manufacture or to make or to sell a product or a service. So the formula for calculating profit is going to be your income, which is going to be your income that you may generate from sales. It's going to be income minus your expenses, which is money that goes out of the business. It could be these expenses or costs of actually producing a product or a service. So if your income is bigger than your expenses, then you're operating at what we call is a profit. But if your expenses exceed or are greater than your income, then your business is operating at a loss. It means that you are not generating enough money to be able to cover or to pay your expenses. So there are two types of profits that we need to be able to calculate as business owners or as entrepreneurs. We need to understand how to calculate gross profit, and we need to understand how to calculate net profit. So what is gross profit? Gross profit is the profit that is earned by the company after deducting the costs associated with making or selling a product or a service. So gross profit is the profit that you make after you have subtracted what we call your cost of sales. So your gross profit is your sales minus your cost of sales. What are cost of sales? Cost of sales are the costs that are associated with making or selling your product or your service. Net profit is the profit after working out all of your expenses that were not calculated in the gross profit. So net profit is your gross profit minus your expenses. Remember, when we're calculating gross profit, we just looked at sales less cost of sales. We looked at all expenditure that related to the production of the product or the service, and we didn't look at other expenses that you incurred as a business. So here is the formula on how to calculate gross profit and net profit. So to calculate gross profit, we take our sales, our income, and we minus our cost of sales, or what we call cost of goods sold. Cost of sales is calculated by calculating your opening stock, your purchases, your transport costs, minus any stock that you've returned, and also minus your closing stock. To calculate your net profit, you then take the figure of your gross profit and you minus other operating expenses. Other operating expenses could be things like your rent, your electricity, your depreciation, etc. So how do we calculate cost of sales? Or how do we calculate costs of goods sold? We first of all need to find out for a month what was the opening stock. So what was the opening stock figure? You then need to add any purchases, so any stock that was purchased during the month. You then need to add what we call your transport costs. Remember that when you go to buy stock, you are going to incur transport costs. So you need to factor in those transport costs. You then need to subtract any purchase returns. What are purchase returns? You may return stock back to your suppliers because it's spoiled or because it is not in the acceptable condition. So you minus those purchase returns. And you need to also minus the closing stock. So any stock that was left over at the end of the month, we subtract. Once you've calculated all of that, then becomes what we call your cost of sales. So as a business, you need to be able to calculate your gross profit as well as your net profit. Let's revisit the concept of gross profit and how we calculate gross profit. Remember, we said gross profit is equal to sales minus your cost of sales. So when you're calculating gross profit, you need to find out what were your sales for a specific month, what were your total sales, and then you would minus what we call your cost of sales. To calculate your cost of sales, you would find out what was your opening stock. What's the value of your opening stock? You would add any purchases of new stock. You would add any transport costs that you incurred to go and actually purchase your stock. You would minus any returns, any stock that you may have returned to your supplier, and you would minus your closing stock. So stock that you had left over at the end of the month. So the difference between your sales and your cost of sales would then give you a figure for gross profit. Let's use an example to see how you would go about calculating gross profit as well as net profit for your business. So this is a short case study about Zanele. It says that Zanele runs a tuck shop in Soweto. She made 6,000 in sales last month. At the beginning of the month, she had opening stock worth 500 Rand. She bought additional stock to the value of 1,600 Rand. She returned stock to the value of 300 Rand, which was mostly off. In order to fetch her supplies, she had to hire a bakkie from her cousin, who charged her 400. At the end of the month, she had stock worth 600 Rand. The monthly expenses are telephone, water and lights 150, rent 250, salaries 1,200, bank charges and advertising to the value of 100 Rand. The total expenses are 1,950. So how would you calculate Zanele's gross profit? Remember, formula for gross profit is equal to your sales minus your cost of sales. So Zanele made sales of 6,000 Rand last month. So we would calculate her sales of 6,000 Rand minus her cost of sales. Remember, to calculate cost of sales, you need to look at what was her opening stock at the beginning of the month. Her opening stock was 500 Rand. We need to look at what were her purchases during the month. It says that she bought additional stock to the value of 1,600 Rand. We need to look at what were her transport costs as well. We add those. It says that she hired a bakkie from her cousin to the value of 400 Rand. And then we need to subtract any purchase returns. We are told in the case study that Zanele returned stock to the value of 300 Rand, which was mostly spoiled. We are also told that at the end of the month, she had stock left over of 600 Rand. So we'd have to calculate all of these figures for her cost of sales and then minus it from her sales. So as you can see, her cost of her sales was 6,000 Rand. We then subtracted her cost of sales, so her gross profit is 4,400. We also need to calculate Zanele's net profit. So how do we calculate net profit? We calculate it as gross profit less expenses. Remember, there are certain expenses that were not covered when we were calculating our gross profit. So we already know that Zanele's gross profit is 4,400. But in the case study, they told us that Zanele had a number of other monthly expenses which totaled up to 1,950. She had a telephone, she had lights and water, she had rent. So to calculate net profit, we would take a figure from our gross profit and minus it, and minus all of the other expenses that were not covered under gross profit. So the net profit that Zanele earns at the end of the day is 2,450. In the previous slides, we discussed cost of sales and how to calculate cost of sales, gross profit, as well as net profit. What you need to be mindful of is that in a service business, examples of service businesses could be a hair salon, it could be a car repair shop. We do not necessarily have what we call a cost of sales. We calculate what we call is cost of revenue for the business. Remember, in a service business, you do not have inventory or you do not have stock. So therefore, you cannot really calculate cost of sales, and you're not really manufacturing an actual product or service, but you are rendering a service to your clients or to your customers. So for a service business, you will calculate what we call is cost of revenue, which is similar to cost of sales. For a service business, cost of sales does not make sense. We therefore calculate what we call is cost of revenue. Cost of revenue is the total cost of delivering as well as making a service. It's all your direct costs that are associated with the service. By direct costs, we are referring to your direct labor cost, your raw materials that you may have used, your transportation costs that you may have incurred in rendering the service. Cost of revenue is going to be made up of your raw material, your direct labor cost, your sales from commission if you have an agent that charges you commission, as well as your shipping and your transportation costs. So in a service business, we have what we call is cost of revenue as opposed to cost of sales. In the next slide, we will look at an example of how you go about calculating your cost of revenue for a service business. Here is an example of a service business and how we go about calculating cost of revenue. So this is the example. We've got Mike's Delivery Company. They generate sales, meaning they generate revenue to the value of 20,000 Rand per month. They incur the following expenses. They incur fuel for deliveries value to the value of 2,000 Rand. They incur salary for the driver who's doing the deliveries, who's paid 3,000 Rand a month. They incur rent to the value of 2,000 Rand. They pay insurance to the value of 1,000 Rand. And they pay stationery to the value of 400 Rand. Remember, we said to calculate your cost of revenue, you need to add all the direct costs that are involved in you actually rendering the service. So in this instance, Mike is a delivery company, meaning that his core service or his core business is providing delivery services. So Mike's direct costs are going to include the salary that he pays for the driver to do the deliveries on a day-to-day basis. He's paid a monthly salary of 3,000 Rand. Other direct costs that Mike incurs are his fuel costs. Remember, he needs to fill up his vehicle with fuel each and every day to conduct the deliveries. And those fuel costs are to the value of 2,000 Rand. The rest of the other expenses, he has to incur them, but they're not necessarily as a result of him delivering or rendering the service. So to calculate his cost of revenue, we are going to add the 2,000 Rand as well as the 3,000 Rand, and that is going to be his cost of revenue for rendering this service, which is going to be to the value of 5,000 Rand. To calculate his gross profit, we'll then use the gross profit formula that we discussed earlier and say sales less cost of revenue. In this case, he's generating sales to the value of 20,000 Rand, so it would be 20,000 Rand minus 5,000 Rand, which was his cost of revenue. So his gross profit per month is 15,000. To calculate his net profit, we take his gross profit figure and subtract our operating expenses. So from the case study below, we know that Mike has got the following operating expenses. We know that he pays rent to the value of 2,000 Rand, he pays insurance to the value of 1,000 Rand, and he also pays stationery to the value of 400 Rand. So in the end, Mike's net profit is equal to 11,600. So if you are a service business, be mindful of the fact that you do not necessarily calculate cost of sales, but you do incur what we call a cost of revenue, and you must calculate those and be mindful of those costs when you're calculating your gross profit as well as your net profit for your business. As a small business owner, you need to make sure that you price and you cost your products appropriately. When it comes to costing and pricing, you must calculate the true cost of manufacturing or producing your product or service. So meaning that you must factor in all the costs that you incurred while you are manufacturing the product or the service. When it comes to pricing, attaching a certain value to a certain product or service, pricing is determined by market conditions. Pricing is determined by demand and supply. So when you are pricing your product and service, you must be mindful of the market conditions that exist within that particular industry. When you are setting your price and your costs, you must make sure that you are able to recover all the costs that you incurred in the actual manufacturing or production of the product or service. There are two types of costs when it comes to manufacturing of products and services. There is what we call a variable costs and fixed costs. Variable costs are costs that will vary, that will change as a result of changes in production or in output. Examples of variable costs can be your material costs and your labor costs. They are variable in the sense that if production increases, then definitely the cost of material and labor are going to increase. But if production decreases, the cost of material and labor may decrease. So these costs will fluctuate, they will change based on the level of output or production. Your fixed costs are costs that will exist within the organization regardless of output, regardless of how much production you are actually producing. Examples of fixed costs will include things like rent, it will include costs such as insurance. Some costs cannot be entirely variable or fixed costs, but they will be semi-fixed or semi-variable. Example of such costs are your telephone costs, which can sometimes be semi-fixed or be semi-variable. When you are setting your selling price, you must make sure that you are able to cover both your fixed cost and your variable cost. But when you are setting your price, you must also be mindful of the supply and demand as well as the market conditions that exist within the industry or the environment in which you are operating or selling your product or service. When you are setting the price of your product or your service, you also need to look at what we call your competitor pricing. So you need to consider various pricing elements that relate to your competitors. Firstly, you must look at the price of your product relative to your competition. So you must compare your price towards other similar products that are offered by your competitors. So you must look at, do you offer a unique brand? Does your product have unique features to justify the higher or lower price? So you must compare competitor pricing with your pricing. You must also look at the distribution of sales by price point to your relative competition. So look at, do your competitors raise or lower the price at certain periods, at certain seasons, in certain holiday towns, in certain tourist attractions, so that you are also able to adjust your pricing of your product appropriately. You must also look at things like elasticity of demand of your product. So what we mean here, if the product goes on sale, do sales go up or do they stay the same? Because if your product is on sale and the sales definitely go up, it means that the price of your product is elastic. You can easily change price to boost sales. But for certain products, the price is inelastic, meaning that even if it goes on sale, the quantity or the volume of sales will still stay the same, or people will still continue to buy the product. So it's important to understand demand as well as elasticity of demand for your product or the service that you're offering. You also need to understand the cost structure of the product category. You need to understand your competitors' prices or their price points. You need to understand their stores, the brands that they sell. Are they more or less than yours? You also need to look at their promotions, their partnerships, their distribution outlets, whether they sell on credit, what's their return policies, how are they charging their product in relation to yours. So it's important to analyze how your competition is pricing their product or service, so that when you are setting your price, you are also able to adjust your price so that it's set appropriately. As a business owner or an entrepreneur, it's important to understand what it means to break even and also to be able to calculate your break-even point. Your break-even point is the point at which your business is producing enough revenue to be able to cover its fixed as well as its variable costs. So at your break-even point, you are not producing a loss or a profit. You are just producing enough to be able to cover all of the costs that you incurred to produce or to sell your product or service. You're producing sufficient revenue monthly to cover your fixed and variable costs. Your break even is when your total costs is equal to your total revenue. So the cost that you incurred is equal to the revenue that you've generated in your sales. You are neither making a profit or a loss. Once you've generated your break even, any additional income after that then becomes what is your profit. You need to know exactly how much sales you need to generate to break even to be able to cover all your costs that are associated with producing your product or your service. You will break even when your total revenue per month is equal to your total costs per month. When your unit sales per month is equal to your total fixed cost divided by your unit sale price minus your variable costs. So in order to be able to know what is your break-even point, you would need to calculate what is your total revenue per month and also what are your total costs per month so that you know when you start to break even as a business. You will also need to know what are your unit sales per month, what are your fixed cost per month, what is the unit sale price of your products, what are the unit variable costs of your products, in order to know when you are going to break even as a business. You have reached the end of part 1 of module 2. Kindly proceed to part 2 of module 2, which will contain the rest of the topics for this module as well as the conclusion for this module.